Hi again, this is Phil at the Laptop Trader channel on YouTube. Welcome back to our community. This is just a quick disclaimer. What we cover, my email contact is laptoptraderphil@gmail.com. Caution, most stock traders lose money. Please protect yourself at all times. This is chapter 4 basics. This is our agenda for this month. We're going to talk about these 10 items. I've got 30 or 35 slides to go through. We're going to cover economy versus the stock market and what affects stocks. We'll talk about the stock market as a system versus a car. When is a good time to buy stocks and when are they on sale? The idea of fear and greed and supply and demand. Why do stock prices move on the day or day after an earnings announcement? How to read the market and the economy for yourself. The long and short of it all. New highs and lows and the concept of a vacuum. My approach using stages and trends to enter and exit a position. Using information to start the day or the week. So this is just a basic model of the market cycle versus the economic cycle. The two are interrelated, but they move at different times. And so many times you can have a like a bull market or an uptrending market, and you can have economic expansion, but you can also have at certain times you can actually have a recession in the economy while the market is still moving up. So some say the market leads the economy, others say the economy leads the market. I'm not sure it really matters, but that's just kind of something interesting that happens. So what affects stocks and stock prices? Well, the general economic environment will affect stock prices for sure. Most of our economy is based on consumer spending. So specific industry moving up or down, and certainly not secular but cyclical industries like durable goods are generally cyclical, like automobiles or major purchases can be very cyclical in nature. Interest rates, the money supply, inflation rates, our cost of our dollars versus foreign currencies can affect the markets. Certainly, an earnings report and stocks can move wildly around an earnings date, so be aware of that. Future outlook for a company or an industry and the valuations around a company or an industry. Certainly the idea of growth, which is Wall Street's favorite word, growth. The general trend of the overall market, or what stage is the market in, can affect stock prices in general. Supply and demand of any single company or any industry at that point in time will certainly affect prices, which relates to the idea of overbought or oversold. I want you to be cautious about those terms because they can be very subjective. Government business policies, whether local, state, or national, can certainly affect not only stocks of public companies, but certainly private companies in those local areas also. Is the company a leader or a follower, or is it a Wall Street favorite? So many companies lead their market and even lead the overall market higher, and many companies just kind of go along for the ride. Options expiration not always does not always affect stocks, but it's good to know in the short term. Options expiration can have a slight impact on stock prices. I would say that's the least of a concern for a longer term investor. And is the company or industry in a cycle? Like I mentioned earlier, like automobiles, is the industry in a growth phase? Is the company a new stock in a new industry? Or is it an old company in an established market like agriculture, which is probably going to follow, the agriculture market up and down. So these are just factors to consider as far as what affects stocks and stock prices. So I was trained to look at systems and dissect something based on system malfunction, basically. So if a customer was to bring me an automobile and said, I'm having a problem and the car's not running right, well, I wouldn't focus on the interior system or the seating system. I would go right to the powertrain or the engine system if that was the complaint of the customer. So you could kind of break things down sometimes to make them easier to understand. So I look at the market as a system, and it is. It is it's an auction system, really, but that system is comprised mainly of these 11 different sector groups. Everything from information to real estate to industrial companies to consumer products, healthcare. So this is the big system of the market that I kind of look at. So we want to focus on stocks that are moving the direction that we expect. And many times, certain sectors will be moving up, certain sectors won't be moving at all, and certain sectors will be moving down at the same time. Depending on your investing style, that's where you want to start your focus or your search. When is the right time to buy stocks? Well, this is going to really be a personal choice based on your own economic factors and not so much on the market. Why is that? Because the market over the last 100 years in general has gone up. From a long-term investment point of view, there really is not a bad time to buy the market or an index fund. If the market is in a downtrend, then you are buying at cheaper prices. If the market is in an uptrend, then you're buying and participating in that move up. If you have your finances in order, money management in order, then right now is a good time to consider stocks. When it comes to individual stocks to invest or trade, more homework is required to make a quality decision. You don't need to do a university level thesis on the company, but getting some economic or fundamental facts and or some pricing history is going to be very useful for you. Gather some data and then analyze that data the same way every time to come up with a yes or no answer as to the question, should I buy or invest in this company? And then you just wash, rinse, and repeat. We share our approach here on the Laptop Trader, and you are welcome to adopt our approach if you think it is right for you. We lean more on technical analysis and price activity. When are stocks on sale? Believe it or not, some stocks are on sale every day. There's always change in the markets, and every day some sector or company will be moving down to a low point, and some company will be making new highs. The real question should be, is this company or market on sale, or is it in real trouble and potentially going out of business? Bed Bath & Beyond comes to mind. They simply could not overcome the market environment at the time, and their business mistakes sent them into bankruptcy. Over the past few years, looking back, the semiconductor industry was on sale and then moved into a new stage 2 uptrend very quickly. One of the things we look for is stocks or industries in transition to a new uptrend or downtrend. If they turn up and the business is good, then we should be able to participate and make profits from that move up. Fear and greed are two very powerful human emotions, similar to love and hate. Because market participants are human, many times these emotions show up in buying and selling decisions. We can see stage 4 fear when a stock or a market is selling down to lower prices. So that would equal more supply. We can see stage 2 greed when a stock or market is being bought up to higher prices, equaling more demand. So we can see greed and we can see supply and demand on a chart. We'll know greed is at play because investors want to buy more of what is popular and don't want to be left behind and are willing to pay higher prices. Fear is at play because investors become scared when markets sell off and they don't want to lose money. They don't want to hold merchandise, stocks, that are no longer desirable. They are now willing to sell at ever lower prices. In general, it does not feel good to lose money, and so fear kicks in, and they say to themselves, I have to sell now. Here we can see fear and greed on the same company, Zoom. Stock was bought up from around 60 to almost 600 per share. That's greed. Then after the pandemic, the company stock has been sold back down to $62 per share, which came back down to earth to a more reasonable valuation. So we can see greed and fear in the same chart. Nvidia has recently moved up in a very strong way to over 877 per share. Is it overvalued at this time? Maybe, maybe not. It is a market leader and very valuable and has good metrics in a valuable industry. No question greed is at play. We could use trade management if we own the stock to protect ourselves from a major move down. It may double from here, or it may not. We don't know for sure. What we do know is sometime in the future, the trend will change and we should be prepared for that change. For now, the chart is still in a monthly uptrend. Why do stocks move on earnings announcements? Earnings dates are like a report card. If the expectations are much different than the report, then that can send stock prices up or down. If the future outlook changes in a meaningful way, then investors will reevaluate their position and the current price or valuation. Future guidance changes. This is Wall Street language for we were wrong and we need to readjust our forward looking assumptions at this time. This can be up or down, or positive or negative. Earnings surprises up or down. Wall Street does not like surprises, and many times, if there is a surprise, the stock can be punished. Meaningful changes to valuations, or earnings per share, or other ratios, and certainly the forward outlook for that business. Wall Street is under scrutiny for insider trading all of the time. Think of Martha Stewart, who went to jail. So they need an excuse to buy or sell. Full-time, paid, career company analysts who know these companies inside and out. Let's not be naive and think that they don't talk to each other and exchange information. Because the large operators, large funds, do not want to look like they are insider trading, they wait for a major event to buy or sell in a big way. No better time than the date everyone knows about in advance, the day of an earnings report. In my opinion, or in my theory, is that going into earnings, these funds already have decided, based on current information available to them and that they pay for, they already know whether they are going to buy, sell, or hold that company stock on the day or day after of an earnings report. This is why, in my opinion, we see so many stocks gap up or down around earnings, events, or other news or company announcements. Some of these reasons are very legitimate. It is just the timing is suspect to me. When you think of earnings dates, I want you to think of the word volatility. Prices can get volatile and move very quickly or gap around earnings. Here's a weekly time frame of Meta. Notice the earnings, symbol E on the chart, and the expansion of the price range and the volume on or after that date. So we're looking here, right here's an earnings event. You can see this bar is a little bit bigger than the bars before it. And you can see the volume down here is quite a bit more trading volume for that day or that week. You can also see it here on this earnings report, a wider range bar and more volume. Right here's earnings, a little bit wider range bar and more volume. An REB, or range expansion bar, is what REB stands for. Volume traded that day or week is on the bottom. Also notice their transition from a downtrend to the left to an uptrend going to the right, and the large volume spike in that area. So I'm talking about right here. You can see it was in a downtrend, and we had earnings, a large volume spike, and then this stock just turned up. It went quite a bit higher from there. Also notice currently we had a very wide range bar last earnings event on above average volume. And then this most recent earnings event, we had a wide range bar going the other way, again on above average volume, indicating this stock is now being sold, at least in the short term. So it is possible that Meta is starting to transition. That's not for sure. But this wide range bar is one of the largest bars on this chart, if not the largest, the second largest compared to this one. So this is looking like more of a topping pattern. So just use caution. Here's the same chart of Meta, but this is a daily chart. Notice the volume traded on earnings and the two gaps on the last two reports. So right here we had an earnings event on well above average volume, and we had a big gap up. And we had 3 months of not much, mostly sideways pricing. Now we had an earnings event, a wide range bar, a gap down, and another wide range bar on elevated volume. In my opinion, the evidence is clear that when the facts are reported to the public, it is a good time to take action on information that is already known. If the funds took action before the event, then it would give the appearance of illegal activity. The point of this is to use caution around earnings events for any company. Okay, next topic. How to read the market and the economy for yourself. By looking at the overall market, the S&P 500 and the NASDAQ indexes, and the 12 main sector charts, we can get a picture of overall market activity. We can also look at industries within these sectors to get a more detailed view of companies within that sector to see what trend are they in at this time. Once we get that picture and compare it to the market and the economy, we can form an opinion or a directional bias, or bias for short. Our bias should become clear as far as what stage are we in, 1, 2, 3, or 4, and is this particular company or industry group going up, down, or sideways at this time? So what trend are we in? This information, along with other factors, should give us some confidence in our selection process. Other factors will include earnings dates, recession, inflation, expansion, interest rates, growth phase, company metrics, etc. For me, this was an added benefit as it gave me confidence not only in picking general market direction, but along with money management, much more confidence in my personal financial situation. the long and short of the markets. Long generally means buy, and short generally means sell. Just want you to be aware of these terms if you hear them in a discussion about a stock or a market. It is just industry language. So the phrase, I am long ABC company, would mean they bought stock and were looking to profit from prices going higher. The phrase, I am short XYZ company, would mean they borrowed shares of stock and sold short and were looking to profit from prices going lower. It is okay and accepted to profit from stocks or markets going up or down. The easiest way for me to explain going long or buying long and inflation to you is to use buying a house as an example. In general, we expect if we buy a house for the house to go up in value or appreciate in value. This is a form of inflation, and most homeowners brag about their houses going up in value. They were long their house. This is a reason to own housing or property as an inflation hedge. The easiest way to understand going short or selling short is to use the used car trade-in example. Every day, somebody somewhere is buying a new car and trading in their used car in most cases. We know as consumers that the new car is more valuable than the trade-in car. We also know as soon as we purchase the new car and drive it home, it has lost value in most cases. Essentially, the dealer has sold you short on that new car, knowing it is losing value and someday you will return to trade it in for another new one, and they will buy it back from you at a lower depreciated price. Then the cycle starts over. The dealer knowingly sold you an item that was going to lose value and then buy it back from you later at a lower price. This happens every day and is normal. It also happens every day in the stock market with short selling stocks. This is just a quick picture or a graph of what happens when an investor or trader shorts a stock. Borrow stock, they sell the stock to the market, they then buy it back at a lower price, and then they return that stock to their broker. It's the exact opposite of going long. Here would be just a diagram of what happens when you go to the new car dealer. The new car is sold to a customer at retail price. Then the used car is bought back at trade-in at market price. This happens every day. They sell you a new car high, they sell high and sold you short, and then they buy back low. They actually buy to close that deal when you trade in your used car. New highs and lows and the vacuum concept. This is a little harder to illustrate, but basically the idea is that a stock making new highs or lows tends to keep making new highs and lows. Why? Because of the lack of resistance and the unwillingness to buy or sell that stock. Let us look at a stock in a strong uptrend making new highs. We look at a chart and look to the left, and we don't see any price action to the left. We'll see a vacuum. It means there's nobody at this time holding that stock at a loss. This equals a low fear environment and no real reason at that time to sell. So there's no compelling reason to sell, like if you were holding a loss. Everyone who bought is holding a profit of some sort. The same applies in reverse to the downside. Nobody wants to buy into a loser. So prices keep falling until there is a compelling reason to buy or the company is out of business. Let's look at a few chart examples. Think of throwing a basketball in space or dropping the ball out in space. There's nothing to stop it from going farther, a space vacuum. Little to no resistance. A list of stocks making new highs is a great place to start your search. Here we can see again Meta Platforms, and we can see a big vacuum to the left because there's no pricing above this area up here. Here we had a high point, we came down, and we had this high point, and anybody holding stock above these two arrows in this time frame is holding a profit. There is no reason to sell. Buyers keep buying to new highs. No pricing to the left and a huge vacuum area. So you can see here would have been a new high. This earnings event was a new high. Every week on this chart is a new high. It just keeps going higher. So there's no reason to sell, which is why you don't see any selling. One issue with that is at some point in time, prices will become extended or overbought, and it will create a vacuum down here to sell into. And right now we have a little bit of selling here these last 3 weeks. So if prices really get moving, they can definitely come down into this vacuum. Now let's talk about, I just printed here an outline of my approach. It describes how are we going to enter or exit the market using technical analysis and my approach. Let's take a look. I consider myself a price detective. I refer to myself as a price detective as I look for clues to the next probable move in any market or stock. Technical analysis is the study of price action over time and trying to predict future possibilities. We try to put the odds in our favor and play those odds with calculated risks. By looking at the markets this way, we're able to follow the leaders of the market who dominate the financial industry and actually move markets. We're also able to get a very good grasp of what is going on in the economy in general and what industries are moving at this time. I think through practice, you may also feel much more informed about the stock market and the economy as I am. I know this is a lot of information, but over time it speeds up. For example, my weekly game plan only takes 1 to 2 hours to implement, and then during the week, I just keep track of what happens. This is just an outline of my basic approach to the markets. I look for the overall market trend or stage. Then I'll look for certain companies or stocks and what stage are they in. I'll use multiple time frames so that I keep myself on the right side of the market. I try to put the odds in my favor by using different price patterns. Before I enter the trade, I determine what is my risk and reward or potential risk and reward. I look for a good ratio or a good edge on that. And then once I get into an active and open trade, I'll use trade management. So that's just a quick outline. I'm not going to read through all that. Let's talk about the 4 stages. And you'll see these on most any chart if you know about them. There's stage 1, which is at the bottom left. Generally a narrow range stage. It'll look like a consolidation where price is flat. And then at some point, if that company or market starts getting bought up, it will turn into an uptrend, signaling buying, and we generally call that stage 2 a stage of greed. Stage 3 will look like a plateau or a peak. It can also look flat. It can actually sometimes look like there's some wide range bars. Generally, it can turn into a stage of distribution or selling, or it can also turn into a continuation of stage 2 over a period of time. And then stage 4 is an obvious downtrend where there's much more selling, Generally, that is considered a stage of fear. And then on the bottom right, the cycle will start over, or the company or product or service will go away or go out of business. This is just a picture of kind of where you could buy or sell and some different strategies for the different stages. Most people only buy stocks on this left-hand side. They only know how to buy stocks for prices going higher, or they buy stocks for and go long for appreciation. Most people have no idea what to do over here at all. Let's use to reinforce this point. Let's use an industry as an example. So I picked music because I think it's easy to relate to. So stage one, again, you could have accumulation or indifference. You could have a new service or a new product. Something like streaming music would be a new form of music. I can also think of stuff like podcasts, which are very popular now. YouTube's quite popular, obviously, or even MP3s or iPods. And then in stage three, again, more of a plateau for different kinds of music. Radio could be maybe considered a stage three, live concerts, and maybe even MP3s could be considered stage three. And then we have stage four, which are obvious items that are no longer in favor, such as records, tapes, and CDs or phonographs. And then again, the cycle could start over where that company or product or service goes away. One company that comes to mind that would maybe be something like Sony company. I don't know if they're as big as they once were. That's one company that comes to mind when it comes to entertainment and music. This is just what the four stages would look like in reverse. So if we were looking to watch for a transition back to a stage two uptrend, we could see that on a chart. This would just be a line chart of the four stages, just showing a repeating pattern and money actually flowing in and out of a market or a stock. So what is a price pattern? After we have determined the overall stage or the trend of a market or a stock, where we've determined our directional bias, we are now going to look at the picture for a price pattern. In general, if we look at a larger time frame, like the monthly time frame for our stage or trend, then we are going to go down in time frame to find the picture or pattern we are looking for to take action, whether to buy or sell. In general, swing traders are going to use daily time frame as their action time frame. This gives us a good time to enter and exit our trades, as it does not take up a lot of our time sitting in front of a computer all day, such as a day trader would do. So our context or bias will come from a larger time frame, and our action will come from a lower time frame. This helps to keep us on the right side of the market and the trend. A day trader may use a daily or 60-minute chart as their bias or view of the trend and take action on the 5 or 15-minute chart. With technical analysis, the choice is up to you based on your needs and time commitment as to how you will operate your business. Let's now look at some popular recurring price patterns that you may see in any time frame. Any of these patterns can break up or down, and so risk management is key to success. So I just drew 6 pretty popular patterns that I've seen over the years that have worked for me. And we look for these because they repeat themselves and they offer a good risk to reward trade. Remember, our stop loss is going to be based on previous price action and levels of support. Trading is a game of probabilities. Anytime we can reduce our risk, such as with a tighter stop loss, we can have the potential for a higher reward, which is why we generally wait for prices to tighten up and or break out to confirm our assumptions and our expectations. Think of pattern number 4, how we can wait as price consolidates and contracts over a period of time. We let the market offer us a better entry and a better risk to reward. So if you were to pause this and just study this for a little bit, the purple lines are going to be support, and then on top would be resistance. And we're looking for prices to tighten up and then break out. So the green arrow would be considered the prime entry point. But you can see number 4 is just kind of going back and forth, and price tightens up and then it breaks out. And you can see support is getting higher and higher as the pressure builds. And these are just kind of the names that I use for these 6 patterns. So I'll leave that there if you guys want to pause that and review this page. Now with some basic information, let's look at an information provider such as Barchart or Seeking Alpha and see what can we determine using an information service. We will start with the stock market overview, which I get email updates daily in the morning and after market close. Then we can look at a watch list of some top names. No. So this would just be kind of a stock market overview or kind of a homepage on this service bar chart. You can see to the right, there's some new 52-week new highs and lows. There is some general market information of the S&P 500 and the Dow and the NASDAQ. It shows some market leaders, right, and what they did for that day. Then there's some news stories about tech earnings boost stocks. Here's a little thing about top performing sectors, which sectors are moving right now. What else we got? Recent stories. This is their list of their top 100 stocks. So that's another list to consider if you're looking to enter a stock. But there's a lot of information on these platforms, and there's even like this heat map. This is just looking at daily change. You can see on the top of this would be these top 100 stocks, mining, and then towards the bottom we've got transportation and building products. So this is listing the sectors that I talked about in order from highest performing to worst performing, I believe, for the day or the week. We've got, again, today's performance leaders. This will be a list of advancers, how much they advanced. And then if you click on these tabs, you can get a list of decliners and how much they declined for that period of time. Again, here's the price surprises. So I just want to go over that for you. Now let's look at a different provider, Seeking Alpha, which has a lot of the same information, but presented in a little bit different format. So, nothing wrong with either service, but it's just a little bit different format. Both have tabs where you can create free accounts. Both have news links. Both show the major indexes here and what they did for that day, week, or month and stuff. So you can click on this little chart and you get a 6-month representation of right now the Dow Jones. You click on NASDAQ, it'll show a different picture. So there's that. Again, you'll get a lot of different news items on these services, and you also get these opinions of these different opinion makers, trending news. You can create a portfolio for yourself. I believe you can create some watch lists on this platform. Um, Again, it shows top gainers for the day and who's in the news, who's most active, crypto information, top losers, top 5 tech stocks, more articles. A lot of information on these platforms. So I'll let you guys choose which platforms you like to use. You may not like either one of these, and that's fine too. Let's go here real quick. So I create watch lists and portfolios for myself to keep track of what I've already identified that I may be interested in. So let's go to a watch list. And here I just create a list of what I consider the super 8 stocks, right? Microsoft, Amazon, Google, Nvidia, Meta, Netflix, Tesla, and Apple. And then the 9th would be Bitcoin. From here, we'll get some general information. But for me as a visual learner, I like to see the chart. So I will just go to flip charts. And here in flip charts, I can create a chart that's easy for me to read. So I just put on here the price in candlestick form. I put 3 moving averages. I got a short-term 20 period, medium-term 50 period, and a long-term 100 period moving average. On the bottom, I have a volume profile for that day or week or whatever I'm looking at. Right now, we're on a 3-month daily chart. So each bar or each candle is 1 day of pricing information. Okay. So how would I use this? Well, I can use the daily chart alone, and I can see that Microsoft had a new high based on that little half circle. But then it had several days here where it could not make a new high, and then we put in, at this time, a wide red bar, a range expansion bar, or what I would like to call a warning bar. This is a warning bar signaling that I would expect after that bar lower prices, and that's exactly what we got, was lower prices after that bar into earnings. So let's look at what that would look like on a multiple time frame, or if I go out to a weekly chart. Here's a weekly chart of Microsoft, and we can see that Microsoft basically plateaued for 9 or 10 weeks, made a week new high, and since that time has not made a new high, indicating a plateau. Also, we've kind of broken this support area here, but last week we put in this candle where prices moved back up above that support area. So this wide red bar broke support, and then the next bar broke support, but buyers stepped back in and pushed prices back up on the weekly chart. For me, if Microsoft broke this area down here, I would want to be out of Microsoft. Below, let's say, this green candle, maybe 369, I would want to be out of Microsoft based on technical analysis. And if you're even more nervous, if you don't believe in Microsoft or you think this is a sign of further selling to come, you may want to get out now and just see what happens. Or you may be a longer term investor. You may see this dip as a buying opportunity, right? So we had a pullback into earnings. This could be a buying opportunity from somebody's point of view. So let's go down here. I generally like to look at the weekly chart first. Let's just go through these 8 stocks and then we'll wrap up this video. I think that'll be enough of an example for you guys as to kind of what I look for. On the weekly chart, I only have 2 moving averages. I've got a 10 period, the blue line. I've got a 30 period moving average, the green line. So this would be 10 weeks and 30 weeks. And you can see sometimes Microsoft goes up and kind of touches that 30-week line, and then the uptrend will continue. Sometimes it touches the 10-week line. So here, maybe prices will come down to the 30-week line and offer a buying opportunity for, I'm sorry, not Microsoft, for Amazon. So these tech stocks right now are in a little bit of a selling phase, or a short-term downtrend on the daily chart. So you can see Microsoft has sold off over the past couple of weeks. Amazon, right, sold off in a big way. Google is actually showing relative strength. It's been bought up in a big way over the past 5-6 weeks. Google had some prices going down after this earnings report, and then from this point on, it's just been bought. And you can see the buying volume down here. Will that continue? We don't know. Right now, Google is showing relative strength. NVIDIA, similar picture, made a peak, and it's been selling off for the last 3-4 weeks. This week, it put in an inside wide range green bar, indicating that buyers still desire to own or buy NVIDIA. Meta, similar picture, selling over the last 3 weeks. Netflix, similar picture, selling over the last 2 to 3 weeks. Tesla has been selling off since this period back here, since last year, July. Since July of 23, Tesla has been in a downtrend for sure. Is this wide range green bar in earnings a sign that selling is over? I don't know. It could be. It could be the start of maybe people that want to own Tesla at a better valuation and a lower price are starting to take interest in buying Tesla stock there. Apple has also been selling off since this period of December of last year. It also had a selling period since last July into October, November. So right now this was in a range, and right now prices are at the bottom of that range. So there is a question that if Apple can't hold this pricing, there is a vacuum here on Apple to sell into. There's also room for Apple to go back up to the top of the range. So that is in an interesting area there for Apple. And finally, Bitcoin has been in a very strong uptrend since back here in last October, November. Currently, it's in more of a consolidation area between 73.5 and right around that 60,000, just over 60,000 area. Right now, it's towards the bottom of that range. Remains to be seen what will happen with Bitcoin going forward. So I hope those charts help you guys sort and segregate at least the top 8 companies, and just how they look different, right? Each one looks a little bit different. We can see maybe Bitcoin had some relative strength. Something like Google is currently showing quite a bit of strength over the last several weeks. And something like Tesla has been showing some relative weakness to its peers. So these are definitely 8 to watch, because they definitely can swing the markets either way. So those are 8 to keep an eye on. Also, before I go, I'll share with you guys one other list that I look at regularly. That is my ETF list, where I keep a list of all the different sectors and subsectors that I like to keep an eye on, such as this ETF of SPY, the QQQs, which represent the NASDAQ, IWM, which represents a broad base of 2,000 stocks, DIA, which represents the Dow Jones Industrial Average, Transports, IYT, and others, such as the volatility or the fear index, mid-cap stocks, symbol MDY, small cap stocks, symbol SPSM, and then I've got the 11 sectors right here. So I've got energy, financials, consumer discretionary spending, healthcare sector, XLK technology sector, utilities sector, the industrial sector, this is materials or raw materials sector, communications sector, XLC, consumer staples, items that consumers buy over and over, the staple items. And finally, the real estate sector. So after that, they start going into subsectors or industries, such as retail or retail companies. Sometimes I look at bonds as represented by TLT. Sometimes I'll look at something like this symbol block, BLOK, which is about data sharing. Or maybe I want to look at marijuana, symbol MJ. Or there's even international ETFs like EWZ, which represents Brazil. Or I may even look at something like commodities like oil services. So it just depends what, some things are going up, some things are going down, some things are going sideways. And that helps me to separate out those market systems so I can make a quality decision based on price. So let's end that video here. I think that is enough for you guys at this time. Again, I'll give you my contact info one more time. Again, this is Phil at the Laptop Trader. If you have any questions, comments, or concerns, you can contact me at laptoptraderphil@gmail.com, and we will see you on the next video. Goodbye. Have a safe trip.